So, public capital markets and technology valuation. I've worked in investment banking for 10 years. I've done a bunch of IPOs. Started with carsales.com right back in the early to mid-2000s and followed this right through to even last year working on the IPO of a Chinese internet employment .com website on the New York Stock Exchange. So this is a sort of series of my observations about public markets and how they interact with technology. Earlier today, particularly this morning in the venture capital part of Matt Barry's talk, we discussed a whole bunch of the things that sit behind venture capital financing and technology. Public capital markets are very different. They are fully diluted, fully transparent. They're real time, there are continuous disclosure obligations. It's a very different beast. Matt talked through a whole bunch of the things that flow on from venture capital financing structures like liquidation preference, where you effectively are stacking all of these cumulative preference shares on top of each other, and you don't really have a real fully diluted view of what a business is worth. Once you IPO and you're listed, every share is pari passu. It's equal, it's fungible, and they're trading live and liquid all the time. The ASX trades 10 till 4, Monday through Friday, but once you're big and large and liquid, there are traded derivatives over your stock that can trade 24/7. In the US, stocks trade after market. It's a very live and liquid market that's going all the time. It is also very quick to raise capital, and that's another distinguishing feature from the venture cap situations that Matt talked about this morning. We bought a fantastic business called escrow.com at Freelancer, which we bought in April, and after we signed the sale contract for that business, we were able to raise $10 million in just over 2 hours on a Friday night after market at a premium. So these markets are live and liquid. There's no 2 to 3 months to try and get a round out and all this kind of negotiation. You're put on a really fungible liquid platform. But it comes with some obligations. It comes with a really interesting obligation around continuous disclosure. There's nothing that you can't tell people. Anything that's materially price sensitive, you have to disclose to everyone immediately or go into a trading halt. So the whole paradigm is very different for technology companies once they're there. There are some carve-outs for things that are confidential or incomplete and a whole bunch of fairly logical stuff, but it puts you on the spot 24/7, 365 in a very liquid, live, dynamic marketplace. What's also interesting, and Matt discussed and had that little slide of a marketplace with no one in it. It's very difficult for venture cap funds to get in and out. There's a lot of friction there. Not like that at all when you're listed. People can get out instantaneously, and public markets have very little patience. Look at Dick Smith this week, which was guiding to a certain figure, 48 mil, I think, of NPAT, and came out with an update under their continuous disclosure obligations, which knocked 35% off the value of the equity in that business in about 5 seconds. So public markets lose patience very quickly. Public markets also use this fundamentally different way of valuation. This is a kind of cheeky summary of all of the venture cap valuation that people have discussed at various talks and workshops today around how you raise X for Y. You might raise $100 million off a $1 billion valuation, and the way that people are deriving these valuations in really early stage companies is there's a lot of intangible features of how these valuations are put together, and public markets are not like that at all. To actually get into some of the interesting things about valuation trends of technology companies, you've got to debunk some of the handful of acronyms and really annoying terminology that people in public markets use all the time. They're all actually super simple, and it's really easy to cut through all the complexity and all of the jargon here. And there are 4 points that really matter. The first is how public markets look at earnings. Everyone in this room who has a startup is acutely aware of their revenue and broadly of their costs, but not necessarily aware of how that might fit into your P&L statement if you were a listed company. There are broadly 2 ways that the public markets look at earnings. And the first is profit, or NPAT, stands for net profit after tax, all the way at the bottom of your P&L. After you've paid interest to anyone that you've borrowed money from, after you've paid your taxes, after you've done all of the work that goes into that absolute final, returns to equity holders profit number. But public markets also use another lens for this, which is called EBITDA. Stands for earnings before interest, taxes, depreciation, and amortization. Has a cousin called EBIT, which we can just ignore for this purpose. And that's about halfway up your P&L. And it adjusts for a few things. It doesn't include interest. And it doesn't include all of these things that go to look at your tax liabilities. So people kind of see this and say, what does this actually mean? And why do public markets use it? And why do I see it all over the place when I look at public market valuations? It's really simple. It's just a way of looking at the earnings of your business without your capital structure baked into it. So if you and I had a very similar business in a similar industry, similar operating margins, We might have a very different NPAT number because I've chosen to finance it with a lot of debt and you've chosen to finance it with a lot of equity. So that profit line, when it bakes a capital structure, it really implicitly has all of your funding choices baked into it, can be very different. That's quite hard to compare. So public markets a lot of the time use this other number, EBITDA, which just strips out the capital structure, and then you can start to compare things more easily. That's something that can really easily be confusing when you look at how public markets actually benchmark and do a lot of valuations. The reason all of these are really helpful is in the same way that Matt said, go and find and look at the S1 filings, look at public company filings about your peers. The huge, rich information set of all of the competitors and potential people doing things slightly different to you that's out there in public markets because of these disclosure obligations. And understanding how you can look at their financial statements can be really insightful for you in terms of how much other people are spending on certain things at certain line items. Those two earnings metrics, the one that bakes your capital structure and the one that doesn't, also tie into the two broad ways that public markets talk about the value of a business. And one is just equity, and that's typically market capitalization. So just the rump returns to ordinary equity holders. And that's a pretty well understood concept. But the other one is enterprise value, which most people find really confusing. And enterprise value is just the value of that equity plus the value of any debt less any cash. It's really simple, and the reason people do this is if I want to think about the whole value of a business, if I want to buy and control the whole business, I don't just need to buy the equity, I've also got to buy the debt to actually control the whole capital structure. And it subtracts cash, because cash is just cash. No one talks about buying cash. You buy it dollar for dollar, absent any sort of sovereign risks or other things which you set aside for simplicity. So this enterprise value becomes a really important concept when you have debt in your capital structure. You need to think about the whole value of a business. Multiples are typically, a shorthand way that a lot of public market benchmarking and valuation is done. And I want to talk about some interesting trends in capital markets in a minute, but it's important to understand how the multiples work. NPAT, this profit function, is used with equity. When you hear about people talk about a PE, price to earnings, it's just your market cap to your profit. And it's pretty well understood, but it's important to understand how they're defined, and so you can actually see how this works in financial markets. That capital structure free one, earnings before you pay your interest and all of the other non-cash stuff, is paired with enterprise value. Because when you think about flows to who owns a company, debt holders and equity holders both have obligations from a company, that really broad definition of earnings that includes what you're going to pay to interest and everything actually ties into that. And the multiples are really simple. It's just relativity. You talk about price to earnings, EV to EBITDA, which is just that broader definition of the value of a company and the broader definition of earnings. It's just about being able to compare like for like. We can make some observations, and we will later, on how Amazon and Google might have slightly different PEs. It doesn't matter that one's larger than the other. You can compare the multiples of a small company to a very large company. And that's where the benchmarking gets really interesting. Ultimately, what are the drivers of public market valuation? It's not always a guy with suspenders and a cigar and scotch. It can be, and I've seen a lot of that. But there are a huge amount of things that actually go into determining these public market valuations. And in public capital markets, there's no answer. It's very difficult to explain everything. You can't sort of A/B test it and just back it all out and work out what's actually contributing to valuations. Financial metrics are extremely important. Obviously, revenue is everything for technology companies, and I'll get onto that in a moment. Revenue, your profit function, but also other things like how cash flows through your business. Investors in public markets and people benchmarking valuations will look at your cash flows, also how your cash converts. Because when your business gets larger and more complex, depending on the nature of it, you might recognize revenue and then cash later. Sometimes you might get cash flows before you get revenue. And those sequencing things become really important considerations for how people value your business and value the implicit risk in your business. Outlook statements are really important. When you, as a public company CEO, CFO, as a management team, get out and actually say, this is what we think is going to happen. This is where we think our business is going. These are our forecasts, guidance, everything that you put out there. In the US, there's this concept MD&A. If you see that, it just stands for management, discussion, and analysis. And certain companies are obligated to put it out there. It's a really rich source of information. If you've got a US-listed peer that's doing anything even close to what you do, they're obligated to go and write and talk about the trends in certain parts of their business, which is hugely influential. Analyst consensus is really important, because when you're large and liquid, independent research analysts write really long reports on you, and behind those reports are really big financial models. And these reports are consumed by the investment community at large, and how the analyst community actually thinks about your business becomes hugely influential. Don't be misled by the consensus part of it. It's actually not a consensus at all. It's a simple average, and that's often very confusing for people. Your peers, other listed peers, are hugely influential, particularly around IPO. When we were looking at listing MYOB, Xero was already listed. So people go straight to, well, I could go and buy Xero right now. What am I going to pay for MYOB? Well, it's going to be above or below, and how am I going to back it out? But they've got an incredibly useful reference point that's immediately available straight away. And there are a whole bunch of other things as well. It's not an exhaustive list. This analyst consensus thing is really important. These analyst curves, I won't go into the detail, but broadly how the analyst community sees the earnings of two businesses, realestate.com.au and Fairfax. You can see obviously that over time, the analyst community and everyone else is thinking that the earnings of REA are going up and Fairfax is going in the opposite direction. It's hard to imply causation, but it shows that it's really important. And it's a concept that's just not understood very well. Where does this analyst consensus live? At Freelancer, it actually lives in our Bloomberg room, where we have a Bloomberg terminal. But people in the investment community, when you're listed, will go and do this. They will subscribe to Bloomberg or Thomson Reuters or a whole bunch of things, and they'll go and they'll actually consume this data day to day. The real question for this group of people who are having startups or businesses that are approaching the point where they might want to tap capital markets for a whole bunch of reasons, fundraising, liquidity, all of the things that you can do in public markets. What matters? In technology businesses, it's revenue growth. It's very simple. It is the most significant driver of the valuation in your business. This is a scatter plot. This is using some of the concepts just from right at the start there. This is plotting how fast you grow your revenue against the multiple that you get for that revenue, EV to sales. So if you had $100 million worth of sales, if you want $1 billion valuation, if you want 10 times as your multiple, you need to be growing at 40, 50, 60%. And that R squared is massive. It is hugely determinative. If you want a really punchy trading multiple, revenue growth is the single most influential factor to actually get that valuation for you. When you're larger and you have earnings becomes really relevant as well. The correlation isn't quite as much, but it's still a very important correlation. I'm going to skip over that in the interest of time. People look at how public markets trade, and IPOs are a great example. Some IPOs trade up and some down, and why? Obviously, depends how tightly you've priced it in the first place, how aggressive you've been, whether you've left some value on the table, and that's an entirely separate discussion. But again, this revenue growth concept is hugely influential. This is a chart of a whole bunch of tech IPOs recently. Some have traded up, obviously some have traded down. It's not profitability. The ones with red logos are loss-making businesses. The ones with green logos are profit-making businesses. Clearly it makes no difference. So if you go and unpack this and just dig into the data a bit more, what does make a difference? Turns out the top two make a huge difference. The size of your revenue check. If you've got $400–500 million worth of revenue a year, that's being really bid up and valued by public markets. If you have a really high revenue growth rate, that's also really being bid up. Turns out the size of your business, your market cap, makes no difference. Whether you're profit or loss making and the degree to which that's the case. At this point, for technology companies that are IPOing, seeking funding, doing a small sell down, whatever it may be, for tech companies in public markets, it's revenue and revenue growth. This question is asked of me a lot. Will macroeconomics hit my valuation as a tech company? Yes. If you are listed, if you are in public markets, you can wake up one morning and an obscure Eastern European country has changed its monetary policy and raised interest rates by 25 basis points, and you can have a massive hit to your valuation. Public markets are very exposed to these things, and technology is not immune to that at all. The question though becomes, where does this end? Because you are not going to be able to earn this high valuation from public markets just by growing revenue and having revenue and not actually letting anything drop to the bottom line. Because ultimately, people want to know that this revenue, this is the question with Uber, right? And I think Matt alluded to it before, you can raise a lot of money, and if you're raising it just to grow your revenue, and it's really difficult for people to work out whether you can generate earnings from this in the future, it can become a bit of an overhang on your valuation. So it's really important to be able to articulate that, yes, you're growing all this revenue and you have this big revenue line, but that you can actually monetize it at some point in the future. A couple of little micro case studies that are really interesting. For us at Freelancer, we have articulated very clearly that we're running the business at this point in time flat at the earnings line. No profit, no loss, effectively, plus or minus a small amount. Now, we're operating cash flow positive, which is great, because we run a marketplace business and people come to us with money, which is brilliant. But what the analyst community has done, those research analysts from before, is actually really unpack the business and say, yes, you're growing at 40% period on period, but you then go and reinvest that into hiring more engineers and growth, data science, everything that you need. Canaccord, as an example, this analyst report has unpacked that and actually looked synthetically at what our earnings would have been X the new growth hires, which is one kind of interesting way to do it, and public markets will do this. The other fascinating one is Amazon, which is for a very long period of time, and Amazon's obviously massive, but it's been loss-making for a very long period of time. And more recently, the Amazon management team has let earnings drop to the bottom line in a quarter. They've actually done it 2 quarters in a row. The last one was a real surprise. That's still against the background of their management team saying, we're not actually here to make a huge amount of money over time. You know, in the near term, we're going to keep reinvesting. But it's a signal to public markets by dropping out those earnings and saying, we can earn on this revenue if we want to. We've demonstrated that to you. Off we go. We're going to go and keep reinvesting this. All of these observations lead us to a more interesting point, which is to ask the question, there are so many unicorns, in this sense, privately held businesses with massive theoretical valuations. The news at the moment on Uber raising $1 billion at the margin for a theoretical $70 billion valuation. This all gets back to the fundamental difference between these two markets. This private land of liquidation preference and structured valuations versus public markets, every share, with a few exceptions. There are always some structures and things you can put on top, but the overwhelming majority of public markets, every share is pari passu. It's fungible, it's equal, a valuation is fully diluted. You know, take the Uber example, raising a bill at a $70 billion valuation. That's one bill of liquidity at one point in time, and then you kind of extrapolate, you've drawn a straight line through that to get a valuation. Public markets, fair enough. It's very rare for an IPO, for example, to be 100% sell down. Basically doesn't happen. Last time it happened was Myer, actually, when TPG and Carlyle got out of Myer, and it didn't go so well. And people want to know that the people selling equity have a really strong interest in it. But when you put all of that together, yes, an IPO might be 20, 30, 40%, 50% perhaps of the value of a company at a point in time. But then every day that trades. Freelancer's trading right now. I checked before I walk on stage, we're trading at $1.81 a share, which is about an $840 million fully diluted market cap. It's changing, and it's changing by the second. So that you own that valuation. So the question then becomes, all of these privately held businesses that have achieved these massive valuations through consecutive rounds of venture cap, and as Matt articulated, you're not going to do a down round, because the down round ends in one of those terrible pie charts. Does this translate? If all of these businesses wanted to list today, would they keep those valuations in public hands? You've got to pause for a minute there and look at a trend that's sitting behind it, which is quite surprising. Institutional money, funds, the public markets have a range of investors. Almost everyone in this room who's an Aussie citizen would have a superannuation fund. That's statutory. You'd have an AMP, BT, Colonial, Perpetual, whatever. A whole bunch of people would be sitting behind that superannuation fund and investing that money for you with a mandate to do it in public markets. They probably own the ASX 200, the S&P 500. They're mandated that they have to hold a certain basket of equities. These 3 funds on the bottom left of that side, Fido, Wellington and T. Rowe, are 3 really massive, global but US-focused versions of the Aussie equivalent, the AMPs and the BTs, etc. For the first time in a very long time, these types of funds are investing alongside the Andreessens and the Thiels and all of the usual suspects in venture cap that can play in big ticket sizes. But for the first time, these guys are actually investing alongside them. And if you actually look at some of the stats, the right-hand column there, year to date, is venture capital rounds above 100 mil. It's split about 50-50 between rounds that are done exclusively by your typical venture capital investor and also by these guys, which is really quite surprising. That's the question you have to kind of think about in the background when you're thinking, are these guys going to achieve the sort of unicorn valuation? Is it going to translate? Is Uber going to list at a 100 bill market cap? Because to an extent, some of these funds have a bit of an incentive to try and make sure that can happen a little bit. It'll be very interesting to see how it plays out. But fundamentally, the question is, if you actually fully dilute a unicorn, you may not actually end up with the public market equivalent. You could end up with a horse with a traffic cone on its head, which is going to be very interesting for a whole bunch of the venture capital funds that are sitting there. What's really important to consider when you look at this, we make a whole bunch of observations sometimes in technology. Mark Andreessen has an interesting view here, which was one of the first quotes I kind of came across when I was thinking about how I actually structure this presentation. And you need to go and think about the multiples and some of the kind of technical building blocks to take away his point. Mark starts by saying that given the really low PE ratios for Google and Apple, and that's back at the start, that the PE ratio of Google and Apple is actually not that much above the average for the Australian market. It's not onerous at all. You can look at some multiples and go, that's extremely onerous, because when you think about it, you're going to pay at any one point in time 100 times of the annual earnings of a business, at the margin to buy a share in it. Probably not. Google and Apple are at reasonable trading multiples. It's hard to say that they're really stretched on that kind of market valuation. So Mark's view is only two things could possibly be true. Either big technology is undervalued, in which case there's no bubble in technology, or all the startups are undervalued, in which case there's no bubble in technology. And it's an interesting view because it's actually very difficult to rationalize all of this. What does all this actually mean? You've got to go right back to the difference between public capital markets and venture markets and think about how they apply to technology. And a really good example is to think about Freelancer, which is a business that is listed, fully diluted, trading live right now. How do I value at the margin? I'm an institutional investor. I want to go and get some exposure to this business. I'm broadly comfortable with the valuation. I kind of understand. I like the exposure. I want to go and invest in it. Well, how do I price this equity? Well, when I was walking up the stairs before, we were trading on the ASX at $1.81 a share. So I'm probably able to go and buy some of that equity. I might have to bid the price up a bit. There might be some people sitting in the market saying, I'll sell you at $1.82, $1.83, $1.84. I might have to bid it up a little bit. But I've got a really interesting reference point there, and I can just go and take it. The venture cap equivalent, if you apply that kind of liquidation preference structure to public markets, you get a really interesting result. How much would you pay for a share of Freelancer right now if I told you that in the event that a trade sale occurred to a big international company, you get twice your money back? You can see the distortion when you think about it in that context. Saying, all right, well, fine, I'll buy one share of Freelancer, but I'll pay, I don't know, $3.60 for it or more, because you're guaranteeing me that if a trade sale happens, I'm going to get 2 times my money, then I'm going to participate pro rata. So it really illustrates the point when you think about that venture capital perspective and apply it to public markets. It kind of doesn't make any sense, which then kind of makes me think, do some of these liquidation preference stacked up valuations really make any sense? All of this then needs to be applied to how you think about public capital markets as an exit route for a startup. There are technology companies on the ASX with market caps in the single-digit millions, $3, $4, $5, $6 million, right up to obviously multi-billion-dollar valuations. Freelancers approaching $1 billion, the car sales Seeks, REAs, all of these kind of businesses. And public markets are very attractive because they're not venture capital funds, and also they're live and liquid, and there are a whole bunch of benefits to it. What can you do now, thinking about a startup that might have 2, 5, 10 mil of revenue, and you're thinking that part of what you want to do in the future is list this business on ASX, for example, which is a great market. And you heard from Rory before that it's a really flexible market, and it's actually a great listing jurisdiction. You need to think ahead. One of the first things that you see when you bring a business to capital markets, you do an exhaustive amount of due diligence on it. You really get stuck right in, and you're asking thousands of questions to a management team. Make sure you're counting everything correctly. If you are double counting something, even in your operating statistics, if you're being cute with any metrics to kind of get it looking good now, you have to publish a 3-year historical when you go and list, broadly, plus or minus, there are a few exceptions. Make sure you get it right. There's no point building any hollow logs, there's no point doing anything that's cute, because ultimately, public capital markets are extremely rigorous. As a director, as a founder, as an owner, underwriters, everyone has really strict liability under all of the regimes that touch public markets. So you've got to make sure that you're doing everything correctly. You also need to consider how you want the financials of your business to look, because you have a huge amount of control on it. I mentioned that before. At Freelancer, we have a huge amount of control over the P&L because revenue is growing at a fantastic rate and we're hiring more people at the margin. So right now, it's at that earnings neutral kind of level. You've got to think about if you were presenting your financials to public markets, do you want to be having a profit then a loss and a profit and a loss and having a whole bunch of things sort of move around through your historicals? It can be much more compelling to be able to present, different phases and different narratives around how you've built your business and when you start to move around some of those line items on your P&L. That P&L volatility can be really off-putting to people, and then you end up explaining, why certain pieces have moved around. And that comes right back to the kind of explanatory narrative that you need to have. You need to be able to articulate what has happened in the sequence of all of the financial metrics, not just the operating part of the business where you founded it and you've grown it from nothing to here we are. It becomes really important to be able to do that. Another relevant example for Freelancer, we're growing at low 40s%, 41, 42% revenue at the moment. Last year we grew at 39% for the full year, and people even in public capital markets today will say, oh, that's interesting, why did it grow a little bit did grow a touch slower last year. And you need to be able to articulate that really clearly. In our case, we have a marketplace business that has, millions of projects going through it. We dropped the minimum size of, from about $30 to $10 in this business, which is great for the long-term growth of projects and things that we really care about. It was a very slight headwind to that revenue in a certain year, and being able to articulate that in public markets is really important. So you have to have an answer, which also means that you have to know what's going on. And structuring well is really important, because if you want to IPO your business, you realize very quickly that there are certain windows, public markets are risk on, and you're able to do a deal, and then you can walk straight into a GFC, and you can have public markets close their door on you so fast. If you're not structured well to be nimble and flexible, you can end up in a really bad place. But public markets are great, and I hope to see many of these startups on the ASX. Thank you.